Most people think wealth multiplication requires complex investment strategies or insider knowledge. They study charts, chase hot stocks, and obsess over portfolio allocations. But here's what I discovered after 7 years of spinning my wheels. The real block isn't your portfolio. It's your identity as someone who saves instead of multiplies. I spent those 7 years accumulating small gains while missing exponential opportunities right in front of me. I'd see a growth investment returning 12% and choose the 3% savings account instead. I'd research real estate deals that could double my money in 5 years, then park everything in bonds. I wasn't lacking information. I was trapped in the wrong identity. The shift that changed everything was simple but profound. I stopped thinking like an accumulator and started thinking like a strategic multiplier. Today, I'll show you the psychological trick that rewires how you approach wealth building. It's not about finding better investments. It's about becoming the type of person who naturally makes multiplying decisions. Your brain defaults to accumulation mode because it's wired for survival, not multiplication. This neural pathway keeps you focused on preservation instead of growth, and it's the invisible ceiling limiting your wealth potential. Here's how accumulator thinking works in practice. You see two options: a savings account offering 3% or a diversified growth fund averaging 12% over the past decade. The accumulator mind immediately focuses on what could go wrong with the growth fund. What if there's a market crash? What if I lose money? The 3% feels safer, so that's where the money goes. This is identity homeostasis in action. Your accumulator identity makes you uncomfortable with bigger moves because they don't align with who you believe you are. You're someone who protects money, not someone who grows it. So even when you intellectually understand that growth investments outperform savings accounts over time, your identity pulls you back to the familiar choice. But here's the trap: accumulator identity creates artificial safety that actually increases long-term risk. While you're protecting your money from short-term volatility, inflation is quietly eroding its purchasing power. That 3% savings account loses money every year when inflation runs at 4 or 5%. You're not preserving wealth, you're systematically destroying it. The psychological cost goes deeper than just returns. When you operate from accumulator identity, every financial decision becomes about fear management instead of opportunity capture. You spend mental energy worrying about what you might lose instead of calculating what you could gain. This fear-based decision-making keeps your wealth growth linear instead of exponential. Think about the compound effect of these small, identity-driven choices. Over 20 years, $10,000 in a 3% savings account becomes $18,000. That same $10,000 in a 12% growth investment becomes $96,000. The difference isn't just mathematical. It's the result of two completely different identities making decisions. The accumulator asks, "How do I avoid losing this money?" The multiplier asks, "How do I turn this money into more money?" Same information, same opportunities, completely different outcomes. Your identity determines which question you ask, and that question determines your financial future. Most people never recognize they're trapped in accumulator mode because it feels responsible and mature. Society reinforces this identity with phrases like "a penny saved is a penny earned" and "don't put all your eggs in one basket." But these sayings were created in an era when savings accounts paid real returns and inflation was minimal. Today, they're wealth destruction strategies disguised as wisdom. The neural pathway that created your accumulator identity was built through repetition and reinforcement. Every time you chose the safe option, you strengthened the connection between money and preservation. Every time someone praised you for being financially responsible, you reinforced the identity. Now it runs automatically, filtering every opportunity through the lens of risk avoidance instead of growth potential. Strategic multipliers think fundamentally differently about money and opportunity. While accumulators see money as something to protect, multipliers see it as a tool for creating more money. This isn't recklessness. It's a calculated approach to building wealth through strategic risk-taking. The core mindset shift happens when you change your primary question from "how do I protect this?" to "how do I multiply this?" This single change rewires your entire decision-making process. Instead of immediately focusing on what could go wrong, you start evaluating what could go right. Here's multiplier thinking in action. You have $10,000 to invest. The accumulator sees the 12% growth fund and worries about market volatility. The multiplier sees the same fund and calculates compound growth over decades. They're not ignoring risk. They're weighing risk against opportunity and making decisions based on probability, not fear. Strategic multipliers understand that the biggest risk isn't losing money in the short term. It's missing the compound growth that creates generational wealth. They know that markets recover from crashes, but time lost to conservative investing never comes back. A 30-year-old who starts investing aggressively has a massive advantage over a 40-year-old who finally overcomes their accumulator identity. The compound effect extends beyond just investment choices. When you start making decisions from multiplier identity, you naturally seek opportunities that scale. Instead of working harder for linear income growth, you look for ways to create multiple income streams. Instead of saving every dollar, you invest in skills and assets that generate returns. The daily practice that reinforces multiplier identity is simple. Before making any financial decision, ask yourself what a strategic multiplier would do. Would they choose the safe option or the growth option? Would they hoard cash or deploy it strategically? Would they avoid risk or manage it intelligently? This identity change naturally leads to better investment choices because you're no longer fighting against your own psychology. When your identity aligns with multiplication, growth investments feel natural instead of scary. You start seeing volatility as opportunity instead of threat. You begin thinking in decades instead of months. The key insight is this: wealth multiplication starts with identity transformation, not investment education. You can study every investment strategy in the world, but if you're still thinking like an accumulator, you'll keep making accumulator decisions. Your next step is simple but powerful. Identify one financial decision you can approach as a strategic multiplier this week. Maybe it's moving money from savings to growth investments or researching that business opportunity you've been avoiding. The specific choice matters less than making it from your new identity. Subscribe for more identity-based wealth strategies that actually work.